This is Sarah, and with me my group is Amanda, Maria, Aaron, and Harry Prasad. This presentation is designed to help tax examiners and auditors understand the various techniques used in money laundering and how these can be detected through auditing processes. It draws on practical indicators from the handbook, outlining sector-specific risks, investigation strategies, and the application of source of funds and source of wealth analysis. The handbook is designed specifically to raise awareness on money laundering risks in the context of tax audits. The handbook guides tax examiners and auditors in identifying possible money laundering during the course of their normal auditing work. It doesn't require examiners to become criminal investigators, but rather to be skilled observers and reporters of suspicious financial activity. It covers the nature and context of money laundering activities, provides practical resources and tools available to detect and deter such activities, and it describes how findings can assist criminal investigators in building stronger cases. Traditionally, when we think about fighting crime, we think about detectives solving a case, catching the criminals after the crime has actually been committed. However, over the past few decades, the approach has evolved. In the 90s, crime fighting strategies began to focus more on deterring crime before it actually happens. And one powerful deterrent is confiscating the proceeds of crime. Today, there's an even more proactive method in identifying and investigating the flow of the money and the goods before a specific criminal offence is detected. This is made possible by unusual or suspicious transaction reporting from banks, accountants, real estate agents, and other regulated sectors. Criminal proceeds often appear in financial activity that tax examiners can detect. Some common signs are large cash movements, depositing, transporting, or exchanging, a use of known laundering methods, for example, smurfing or structuring, sudden spikes in income or capital gains, and unusual possessions or loans not supported by legal income. The role of tax examiners and auditors is not only about ensuring compliance with the applicable laws, it's also about spotting red flags that may indicate money laundering or other financial crimes. They have unique access to taxpayer books and records, meaning they can often see things other agencies might miss. So if we're distinguishing the key terms, we're looking at the facts, which can be proven with evidence, for example, a bank statement. Assertion, meaning someone's statement or claim, but not yet proven. Assumption, which is a guess or presumption made with little or no evidence. And the conclusion must be a logical deduction based mainly on verified facts. Using critical thinking as a core tool, examiners will be able to evaluate all assertions objectively, treat assumptions as hypotheses and then test them, and draw conclusions informed by knowledge of money laundering and tax evasion techniques. If you confuse an assertion or assumption for a fact, you risk drawing the wrong conclusion.
This is Amanda. Sources of funds and wealth checks. Sources of funds and sources of wealth checks compare what a person declares as income with their actual financial activity. When these don't line up, tax examiners and auditors see red flags such as unexplained wealth, assets that could not be supported by the declared income, offshore or complex ownership structures, and frequent high-value cash transactions that don't match the stated business operations. Tax examiners and auditors use this analysis to spot assets with no clear income source, lifestyle to income mismatches, and potential concealment through complex legal structures. To validate, tax examiners and auditors should review invoices, contracts, and bank statements, verify claims with third parties like suppliers, banks, and customers, run a net worth analysis, that's assets minus liabilities over time, compare declared income to actual spending, and trace transactions from origin to final use. During audits, best practice is to cross-verify asset values, scrutinise large cash transactions, compare activity with declared income, and flag inconsistencies early to drive deeper review. Applied consistently, these steps help identify transactions that may be designed to conceal illegal origin. Case study: $1 billion false invoicing and money laundering operation. This case study targets an alleged cash for cheques laundering syndicate operating out of Sydney. The syndicate was accused of laundering more than $1 billion to facilitate systematic tax fraud using false invoicing. Around 1,200 businesses were suspected of sending money by cheque or electronic transfer to a purported supplier. The syndicate then generated sham invoices to pretend goods or services were provided, creating fake expenses and concealing income. The businesses then received their money back as cash, minus a commission, letting them evade tax and super obligations while injecting untaxed cash into the black economy. On the 5th of April 2024, investigators executed 7 search warrants across Liverpool, Beverly Hills, Kingsgrove, Cabramatta and Earlwood in Sydney. They seized over $500,000 in cash, financial records, electronic devices and phones believed to contain ledger trails and communications central to the scheme. A gel blaster and fireworks were also found. A 55-year-old man was arrested for an unrelated breach of bail at this time as well. In parallel, the ATO conducted access without notice visits at 5 sites in New South Wales and Victoria to lock down records and disrupt the network. The alleged conduct robs Australians of public revenue. Authorities are warning anyone involved in false invoicing to come forward and make a voluntary disclosure as their investigations continue. Unusual transaction red flags. Tax examiners and auditors play a vital role in reporting of unusual transactions through spotting activity that doesn't fit a client's normal pattern and ensuring it's reported appropriately. Reporting requirements vary by jurisdiction. Some mandate reports, others allow for discretion. As a rule of thumb, always follow current legislation, policies and procedures. When indicators suggest criminal conduct, escalate to the relevant criminal investigation authority. Consistent adherence reduces the risk of missed tax crimes. Cooperation between domestic tax administrations and across borders is essential to combat tax crime and money laundering. Some key red flags to watch out for include unusually large transactions that don't match normal business activity, rapid or frequent transfers with unrelated parties without a clear business purpose, round number transactions suggesting structuring to avoid thresholds, payments to or from offshore or high-risk jurisdictions, shell companies, trusts or opaque ownership structures, related party deals that don't reflect market norms, missing, altered or inconsistent invoices and contracts, weak documentation of source of funds, and gaps between declared income and bank activity or asset purchases. When in doubt, document, consult, escalate, and report. Early, consistent action protects the integrity of the tax system.
Hello, I'm Maria and I'm presenting the next 3 slides. Picture this, no job, no declared income, yet he's cruising in a Lamborghini, sipping champagne on a yacht. That's not just suspicious, it's the financial equivalent of wearing a mask. Money laundering doesn't announce itself, it whispers through contradictions. Auditors look for mismatches, income versus lifestyle, assets versus earnings, sudden wealth, mysterious inheritances, luxury possessions that don't add up. These aren't just unusual details, they're red flags. When dirty money plays dress up, it's our job to see through the disguise. Every yacht without a paper trail is a clue. Every diamond without a source is a story. So we ask, what does wealth look like when the numbers don't match? It's not just about what they own, it's about what they can't explain. Because when wealth wears a mask, it's not the diamonds that shine, it's the lies. This phase is forensic. We dissect numbers, trace ownership, and expose the anatomy of deception. Before the audit starts, we become investigators. Shell companies with no clear purpose, offshore accounts with no logic, a bakery depositing $10,000 a day but selling $3 muffins. The numbers don't bake. We benchmark profit margins against industry norms. If a business is wildly outperforming or suspiciously underperforming, it could signal undeclared income or cooked books. And we don't work alone. Austrac is our lighthouse in murky waters. Their data paired with law enforcement insights sharpens our radar. Every unusual transaction tells a story. Sometimes it's not what's there that matters, it's what's missing. Because behind every number is narrative, and we're trained to read between the lines. Imagine peeling back layers of offshore dealings, vague invoices, and anonymous cash flows. It's like trying to read a book where half the pages are missing and the rest are written in invisible ink. During the audit, we zero in on transactions that defy logic. Money moves without purpose. Third party deals feel like smoke and mirrors. Business owners suddenly don't know how their own operations work. These aren't just gaps, they're warning signs. High risk cases demand cross border data hunts, forensic accounting, and independent valuations to cut through the fog. We're not just auditors, we're truth hunters. We trace patterns, challenge inconsistencies, and expose what's been hidden. We don't chase shadows, we follow the money. And when the trail gets cold, we dig deeper.
Hello all, this is Arun, and in this section I will be presenting techniques and indicators of money laundering across three high-risk sectors: real estate, cash, and international trades. So let's begin with real estate. This sector is often targeted due to its high value and limited transparency. Common techniques include concealed ownership, using shell companies or trusts to hide the true buyer; loan-back scheme, in which criminals lend themselves money through third parties to make their illicit funds appear legitimate; over and undervaluation, manipulating property prices to move or hide money; and the last one is property flipping, which is rapid buying and selling to obscure the origin of funds. The key indicators to watch for: unusual parties involved in transactions such as foreign buyer with no local ties, properties held by inactive entities or left vacant, cash purchases and rapid resales, loans from obscure sources or complex financing structures, properties with no tenants or inconsistent use. Real estate professional plays a critical role in identifying and preventing these activities. Now let's look at the cash sector. Cash is highly anonymous and easy to move, making it a preferred method for money laundering. Techniques include structuring, also known as smurfing, breaking large sums into smaller deposits to avoid detection; cash intensive businesses, using legitimate businesses to mix illicit cash with legal revenues; currency exchanges, converting cash into foreign currencies to obscure its origin. Some indicators include frequent deposits just below the reporting threshold, businesses with unusually high cash flow, reluctance to disclose the source of funds. Monitoring and reporting are essential in this sector to detect suspicious activity. Finally, we turn to international trades. Its complexity and cross-border nature makes it vulnerable to laundering schemes. Techniques include trade-based money laundering, which involves misrepresenting the price, quantity, or quality of goods; over or under invoicing, manipulating invoices to shift value across borders; false documentation, using fake shipping records or custom declaration. Indicators to look for: invoices that don't match market prices, unusual trade routes or counterparties, goods shipped without clear commercial rationale. Stronger trade compliance and international cooperations are key to combating these risks. By understanding these techniques and indicators, we can better detect and prevent money laundering across these critical sectors. With this, I will hand over to Hari.
Hi, I am Hariprasad. Today I'll be covering the topic specific indicators on loans. Loan structures are widely used to launder perpetrators' illicit funds by disguising its criminal origin and finance real estate or the operation of a company without taxation. The loan back transaction is the best known form of money laundering. In this arrangement, the offender sets up a fake loan contract between themselves and a shell company or a cooperative associate. The loan is repaid with clean money, making it appear legitimate income or investment returns. In back to back loan, two entities are involved. Usually, one is in a high regulation country and the other in a low regulation or secrecy jurisdiction. Each party lends money to the other. The dirty money is introduced through one side of the transaction, often the offshore, and the repayment from the other side makes it look like a normal business transaction. In criminal interference, the perpetrator gives the dirty money to company A as a guarantee or collateral. The company A uses its own bank account to send loan to B so it looks legitimate. Due to the loan coming from a legal company and it was used in a business context, the funds are now in the legitimate system. The indicators include offshore lenders in a low regulation or secrecy jurisdiction, absence of supporting documentation, the interest rate differs significantly from market rate, no realistic repayment schedule, large write-off by the lender early in the term or later. Borrowers include persons with criminal records. The next topic is related to professional service providers. Professional service providers are corporations or individuals who provide specialized services. These can include legal service providers, financial service providers, trust or company service providers. Criminals may request services from unsuspecting professional service providers. On the other hand, professional service providers will knowingly provide services for criminals to help them conceal the flow of money. The indicators include unusual services provided by the professional service provider, the professional service provider chosen for the service due to reputation or trust, the reward for services provided, and unexplained transaction income or assets of the professional service provider. The Money Laundering Awareness Handbook for Tax Examiners and Tax Auditors by OECD aims to raise awareness among tax professionals about money laundering and its connection to tax crimes. My colleagues have covered the information provided in the handbook. The key points covered include the definition and importance of identifying money laundering, the money laundering process, the role of tax examiners and auditors, indicators of money laundering involving individuals and businesses, targeting specific areas like real estate, cash, international trade, loans, and professional service providers, the legal context, and international cooperation. The handbook emphasizes the importance of critical thinking, adherence to domestic policies, and international collaboration to detect and deter money laundering effectively. Thank you.